When you invest after the bull run, this is what will happen to your portfolio. One of my friend, who also happens to be my client now, approached me by December 2025, and after watching my previous videos, he showed me his stock and mutual fund portfolio, which had been down by nearly 20% since 2 years. In simple terms, his portfolio of nearly 10 lakh has been impacted, with no income generated for more than 2 years. With the ongoing war and uncertain market conditions, he was not sure whether the stocks he invested in will recover within a year or remain at the same level for a decade. Let me first walk you through a few key points to understand it better. After that, I will show you his portfolio. If you look at the Nifty 50 chart going back to mid 2004, the market began a strong rally from around 1500 levels and reached 6000 by the end of 2007, almost a 4x growth in just 3.5 years. Seeing this rapid rise, many retail investors likely entered the market at higher levels, expecting further growth. However, during the Lehman crisis in 2008, the market fell by nearly 40%, recovered within a year, and then hovered around similar levels for nearly 6 years before the rally, generating little to no wealth for investors. So, ask yourself, is it really possible for retail investors like you and me to see our portfolio remain stagnant for nearly 6 years? Probably no, right? While a few people truly benefited from the bull run after 2020, many investors entered the market once the rally ended by mid 2024. As a result, they got trapped at higher levels and are now holding onto their portfolios, unwilling to exit at a loss. Imagine the regret of not investing that money in a fixed deposit and at least earning a nominal 7% return. There is a saying that markets often repeat the same cycles. What if market would repeat the same cycle in the coming years? Would you like to get trapped with no annual income? Think about it. Let me show you another example to help you understand this better. The Nikkei 225 is Japan's benchmark index, just like the Nifty 50 is for India. As you can see, around the year 2000, the Nikkei 225 was hovering near the 20,000 level, and it took almost 20 years until 2020 for the market to start rallying again from those levels. Now imagine someone who invested a lump sum amount at that time. Would they really wait for 20 years or would they exit at a loss? Obviously, they would exit at a loss. This is why SIPs are always recommended. In times of such global crisis, the best approach is to diversify your portfolio. For this, you need to make use of the tools available at your fingertips. Most people invest out of FOMO whenever they see a market rally. They end up entering at the top. Watching this, institutional investors start dumping their shares, trapping retail investors like you and me. What happens next is that there is no clear exit point. To tackle this, you can pledge your investments and utilize the margin benefits to generate additional returns. This approach not only helps you generate income when your stocks are down, but also allows you to earn extra income when the market moves in your favor too. This is the beauty of diversification. You don't rely on a single investment to perform. If you have an opportunity to generate an additional 6 to 7% return every year despite where the market head to, would you take that bet or let it go? Choice is yours. Let's now review the approach we used for my friend's portfolio. Just to clarify, I do not offer any portfolio management services. I only guide clients in exploring different investment alternatives. The example I am sharing right now represents just 5% of my overall strategy. There are 95% more insights that you need to know while applying these concepts. Now, let's get through it. The current total investment of my friend in equity and bonds stands at 16 lakh 24,000, while investments in mutual funds amount to 3 lakh 76,000. This brings the total portfolio size to approximately 20 lakhs. Before the purchase of bonds in January 2026, the investment in stocks alone was around 9 lakh. The portfolio experienced significant drawdowns across multiple stocks, with declines like more than 20, 30, 40, 50, as well as 60% across all stock investments, as most of the investments were made near the market peak in 2024. Now, at this point, he had an additional amount parked in FDs as savings. He asked me whether he should average his existing stock positions, to which I strongly advise against it. Firstly, his portfolio allocation was not properly aligned. As you can see, the investment amounts across stocks were highly inconsistent. 48,000, 6,000, 61,000, 13,000, 26,000, 20,000, 40,000, 10,000, etc. This lack of proportion indicates poor position sizing, and averaging in such scenario would essentially be playing with fire. Secondly, the broader market represented by the Nifty 50 had declined by only around 12%. Despite this relatively moderate correction, several of his individual stocks had already seen steep drawdowns. This raises a critical risk. If the market corrects further, some of these fundamentally weak stocks could face severe consequences, including the possibility of delisting. In fact, he had experienced a similar situation in the past. In 2022, he invested a total of 40,000 in Future Retail Limited. What was the result? The company eventually got delisted and he lost his entire investment. Now, can you guarantee that none of these current stocks will face a similar situation? No, right? That's exactly why I advised him against averaging. Instead, I asked him to allocate a portion of his FD savings, let's say around 11 lakhs, into government bonds for stability and capital protection. The strategy was to then pledge his existing stocks, mutual funds, and bonds and deploy the capital in a structured way. If the performance turns out well, he can gradually allocate more funds over time. Some of you might have concerns about the losses currently reflected in the bonds investment. Here, the investments were made at a premium or at par value. To better understand this, I recommend watching my detailed video on bonds. Once you watch it, the entire concept will become much clearer. It has been close to 2.5 months since he started investing, executing relatively safer strategies under my guidance, and the result, he made close to 24,000. Over time, he has been able to understand and execute the process with the same 100% accuracy, simply by learning consistently day by day. The 24,000 he earned during this period would have effectively remained unrealized or even lost had he not pledged his assets and followed this structured approach. If this strategy had been implemented over 24 months, which is 8 cycles of 3 months each, this would amount to 24,000 multiplied by 8, which is 1,92,000. In other words, an additional income of approximately 1.92 lakh could have been generated during this period had he been aware of and followed this approach. On top of that, he also received an interest income of 20,000 from 709 GS 2054 on 5th of Feb, which he invested in January. Now that he has developed a strong understanding of the process, he is capable of managing his own funds. There is a saying that practical implementation always outshines theoretical learning. Encouraged by this result, he is keen to invest more funds. However, I have advised him to first observe his portfolio performance for at least 6 months before gradually increasing his allocation. At the same time, it is important to ensure that essential financial foundations are already in place, such as maintaining an adequate emergency fund along with proper health and life insurance coverage. These are non-negotiable aspects of financial planning. One must ensure these first before scaling investments. Now, coming back to my performance, in the first video, we discussed a potential income of 6,000 for the month of November. Let's see how much we have actually done. That's close to 10,000. Now, let's see what we have done from December 2025 till date. The net income after charges is around 59,000, maintaining the same 100% accuracy. Additionally, interest from one of the bond has been credited to my bank account as usual, contributing another 18,000. So the total income comes approximately 77,000. So this year I will be targeting a lower ROI, probably around 14% on 25 lakh capital, irrespective of what was achieved earlier, which was around 17%. The higher returns previously were due to a greater number of expiries. However, after SEBI's order, the number of expiries reduced from 5 days a week to just 2 days a week. Had the number of expiries remained higher, the ROI could have easily gone up to around 24% annually. So, it's often the regulations that impact us more than the market itself. As market participants, we can only hope to see greater transparency from the regulators' end. I'm not claiming that my strategy, which has delivered a 100% success rate over the past 1.5 years, will perform the same way in the future. There is always a probability of loss. The maximum loss I expect with this capital is around 1500 to 2000 on an expiry day, and that too only 2 to 3 times in a financial year, provided there are no technical issues on the broker's end. The strategy has been thoroughly backtested. Had I aimed for much bigger profits, my ROI could have been higher. However, I chose stability over chasing higher returns. The market will always be there. Long term stability should be the top priority for investors rather than short term gains. This approach has worked very well for me over the past 1.5 years. I hope you like this video. Sharing it with your colleagues or well wishers would be highly appreciated. And if you are interested in managing your own funds, you can contact on the given details below and register yourself.